Lots of people are reporting that the stock market is in a bubble of epic proportions. When viewed through the lens of fundamentals, this certainly seems to be the case. One of the most popular measures of market valuation is the so-called Buffett indicator. Warren Buffett made this popular in 2001 when he said that it is, quote, probably the best single measure of where valuations stand at any moment, end quote. In a nutshell, it is the ratio of total market capitalization of U.S. stocks to U.S. gross domestic product. The valuation metric makes good fundamental sense. After all, the gross domestic product is a measure of the value of all goods and services produced in a given year. It's natural to think that since corporations are a major contributor of those goods and services and generate profits accordingly, that the total stock market capitalization should trend along with the GDP. Now here's a chart that I put together that uses the S&P 500 index as a proxy for total market cap. Don't worry, I already checked that this works pretty well and showed as much in an article that I wrote. So here you can see the comparison of the S&P 500 index to US GDP in billions multiplied by 0.08. Why 0.08? It's the value that minimizes the squared differences between the two traces. Now, this is actually a pretty strong statistical correlation. The correlation coefficient is 94.3%, and anything above 90% is generally considered to be a strong correlation. So we have a measure here that makes good fundamental sense and also shows strong correlation. What more could you want? If we trust this measure of valuation, we can see that the S&P 500 is currently 2.28 times what the GDP metric would indicate is its historical norm, even more highly valued relative to GDP than it was at the peak of the late 1990s bull market. The S&P would need to lose 56% to get back to, quote, normal. Now, why did I put normal in quotes here? Simply because we are defining normal based upon the past. There are no shoulds in investing, and so when we say that the market should go down 56%, we are basing it upon some historical measure. Now, before we go selling all of our stocks, we should ask ourselves if this is the only way to interpret the data. There is another way, and I'm going to get to it in a minute. Let's go back to the chart that I showed several videos back. We need to discuss who has access to money and what people in different wealth brackets purchase with their income. This chart appeared in Credit Suisse's 2021 Global Wealth Report. It summarizes the net worth of different brackets of adults worldwide. In Credit Suisse's estimation, there are 5.23 billion adults, and the total wealth works out to be $413 trillion. Now we can immediately see that the wealth disparity is pretty large. 55% of the world's population commands a mere 1.3% of its wealth. 1% of the population commands more than 45% of the wealth. And if you think that this type of disparity exists in income, you're absolutely correct. I'm not putting this graphic up here to instigate class envy. Far from it. I'm showing this to make an important fundamental point. When people of modest means receive income, what do they spend it on? That's right, consumption items. They really don't have many other options open to them. They are living hand to mouth. And the US GDP is primarily made up of consumer expenditures. In fact, 70% of gross domestic product is consumer expenditures. So nearly every dollar that finds its way into the hands of the least affluent, aside from debt repayments and interest, has an impact on US GDP. Can the same be said for the most affluent? No. Those who are at the top of this pyramid and who have access to the majority of the money spend a much smaller fraction of their income and wealth on consumption items. I know that when most people think of the rich, they think of people who own yachts and mansions. But that's really not true according to the work of Thomas Stanley and William Danko. A much larger percentage of the money that people in this portion of the pyramid receive goes towards investment type items. That is, they just cycle it into stocks, bonds, real estate, and gold. Some of it goes into consumption items, but it is relatively a much smaller fraction. So it's natural to conclude that when money flows to the top of the pyramid, it's going to be used to buy stocks, bonds, real estate, and gold. And this is going to gradually drive valuations higher, even when it seems that the real economy is stagnating. In other words, the inflation will be seen in investment assets and not so much in consumer prices. So with that in mind, let's look at another way that we can gauge the value of the S&P 500. Let's measure it against the money supply. Here's a comparison of the S&P 500 index compared to US currency in circulation and M2 money supply. Notice that the correlation is very strong. In fact, for M2, the correlation coefficient is 96.9%, and for currency in circulation, it is an astounding 97.6%. The relationship between the S&P and money supply is much stronger than the relationship between the S&P and US gross domestic product, for reasons that I just provided. It is a true picture of what happens when income flows to the top of the pyramid. When viewed through this lens, the S&P is still overvalued relative to historical norms, but this time it is only by a factor of 1.39 higher. So we could expect that maybe the S&P would have to fall 28% to return to normal levels. But don't forget, the longer that a person waits in cash for the S&P 500 to return to normal, the higher normal becomes. Remember, the Federal Reserve is a money creation engine. Both M2 and currency in circulation grew by 6% annually on a regular basis over the first 20 years of this century, and over the past 12 months, both grew by more than 11%. So long as the money supplies are growing, I believe that waiting in cash or bonds is a losing proposition. Of course, gold is also something that I have shown to increase along with currency in circulation, so there's always that. But the future is unknown and unknowable. So for now, I'm sticking with my 65-35 mix. Good luck, everyone. And please be sure to check out my Patreon site. Thanks a lot.